Welcome to the Opportunity series brought to you by OptionsLake, creating opportunities through the power of options. This series of videos will cover a high-level view of how options can be leveraged by a typical individual investor. Hello everyone. In this video, I'm going to talk about what option strategies are right for different market conditions. So let's first set the context. At any given point in time, we know that the overall market or any sector in the market or any stock in any of those sectors can trend bullish, bearish, or sideways moving. Beyond applying technical analysis to identify such trends, it's very important to choose the right option strategy as it plays a very important role in maximizing your returns. Now let's look at some of the common strategies. So for a bullish trending phase, buying a call or a bullish spread or selling a put may be very common strategies. For a bearish trending phase, buying a put, bearish spreads, or selling a call may be very common strategies. For a neutral phase, iron condor is a very common strategy. So now let's look at some of these examples one by one. This is the first bullish trade, which is buying a call. This is the simplest of the strategy where it has a limited investment or risk and theoretically unlimited upside as indicated by the green arrow. This is one of the example of bullish spread, which can be constructed either with two calls or puts of same expiry but different price as indicated in this chart. But either way you create, you still have the same risk reward with the limited risk and limited reward as is depicted in this diagram. This is another example of a bullish trade, which is selling a put. However, this has some more connotations as we're going to talk about. So number one, this is a credit transaction, which means you receive a credit when you get into this transaction. And the maximum profit for this trade is the premium collected at the time of getting into the transaction. It generally gives good return for stocks with high volatility because high volatility means high options premium. But theoretically, as you can see from the red arrow, it has an unlimited downside. And not only that, it also requires high buying power and margin money. That's why these factors need to be considered and thought through before getting into this kind of a strategy. Now let's look at some of the bearish trades. So this is the simplest of bearish trade, which is buying a put. As you can see, it has a limited investment or risk, but an unlimited upside, theoretically, indicated by the green arrow. Bearish spread, again, can be constructed with two puts or call, but irrespective of how you create, it will still have the same risk reward, which is limited risk and a limited reward. Now let's look at selling a call, which is another bearish strategy where you collect premium at the time of getting into the transaction, which becomes the maximum profit for this trade. Now, but at the same time, what you see here is that it has a theoretically unlimited downside, which means that it requires net high buying power and margin money. So again, these factors need to be considered before getting into this kind of a trade. This is a neutral strategy, which is an iron condor. As you can see, it has a limited risk and limited reward as indicated by green and red arrows. And in this kind of a trade, you are betting on stock to stay within a certain range. So for example, in this trade that is being shown here, we are betting the stock to be between 325 and 375 to realize the maximum profit on the day of expiry. So to conclude, option strategies need to be tuned to market conditions. So what are the steps involved from looking at the market to deciding on the option strategies? Number one, find the trend through technical analysis, which means identifying whether it's a bullish, bearish, or a neutral trending stock or an index. Number two, decide on the direction and aggressiveness of trade, which means it has a bearing on your risk tolerance and also the risk reward that you want to configure and which is favorable to you. Number three, then choosing from a spectrum of option strategies best suited as is given below, right from buying a put to buying a call or anything in between. Thank you. Options is one of the most creative financial instruments available to all of us. And despite many misconceptions that exist around how options are really only for the big guys, there are ways for an average retail investor to leverage options. All it takes is a little bit of foundational education and potentially some hand-holding. That's what we at OptionsLake do. If you'd like helpful tips on options on a regular basis, make sure to hit the subscribe button. For other resources like blogs, articles, please visit our website at www.optionslake.com.